Who in this room pays himself a decent salary regularly? Decent. The key word here was decent. Okay? Now, let's look at someone that doesn't plan for a salary. There's a salary showing up here, but it's a part-time employee. At $154,000 in sales, you could probably get away with a part-time employee and a full staff. But imagine that this is your situation. You do not plan for your own salary. You just wait till you get some at the end. Therefore, your cost of sales, because you need to cover only those fixed expenses, 42%, your prices, you're probably going to have a lower ratio in pricing. What I mean in ratio is how much will you add to your cost of sales. Let's say an album costs you $100. What would you sell the album for? A frame or a portrait, a 16 by 20 portrait. What would you typically sell? Let's say your 16 by 20 is $15. Okay, what would be a factor? Is there a factor? How would you determine the price? How would you determine the price? 30% more?
Or more.
2 or 3 times? Okay, so we got 2 or 3 times, okay. You said 30%?
Well, no.
Okay.
Never mind.
All right. 2 or 3 times is equivalent, 3 times is equivalent to 66% gross profit. Okay? So I'm okay here. I've only got to cover 42%. Do you understand where I'm going here? Yes or yes? Yes. Okay. So 2 or 3 times, 2 times is 50%. Because you know when you go to a grocery store, the gross profit, the profit margin is 30 to 40%. So we figure photography is the same thing. We can do 30 to 40%. If you price your work at 30 or 40% gross profit on it, you will die. This is a service industry. This is not manufacturing. This is not food, a commodity item, because you don't sell thousands of them per day. It is a service industry. Take a restaurant, for example. What do you think is their profit margin in a restaurant? Let's say, I wouldn't talk, I would even put McDonald's in there because they're so precise. But a restaurant, Sweet Tomatoes, or what? A nice restaurant.
7 to 10%, I would say.
Well, they would typically go from 5 to 6 times their cost. What's their cost? The little peas and the little piece of meat and all that. $4.50 cost. They will multiply it by 4, 5, 6, or 7 times. I ask photographers to write 5 times. I want you to go on this. This was a 5. Looked like a 5 in my mind. It's called dyslexia. Is that what it is? 5 times. That gives you an 80% gross profit margin. Yes, Christine.
I think I'm confused because what you're doing ratios as opposed to value. And so people who sell value, the ratio has nothing to do with it. It's the value to the client and it's priced accordingly.
Yeah.
So it doesn't always apply to, if you're selling volume, this applies. If you're selling boutique, it doesn't apply.
Okay.
And it doesn't apply to commercial.
I do appreciate the question because it's an extremely important question. I'll tell you, and here's my response on that. That's the basic. If you don't go there, you're never going to make it to the value, number 1. You're never going to get a salary, number 2. And you got to go there. That's the basic. Then you add the value on top of that. This would be expertise. This would be the time in business, the signature that you offer. Then you add it on top of it. But if you play the game minimum times 5, you will find that you should be able to make a reasonable profit and you can pay yourself a salary. Now in this case, there's no salary paid. So technically, this person said, well, if I have a 42% fixed salaries that I have to cover here, I can only make it by 3 to get a 66%, and I'm home game. Except that you forgot 25 or 30% that goes into your pocket as a salary. So that figure is not real. It's really not real. Am I going too far away here? So you have to think. Here's another scenario. I forgot these little arrows that I got in there. Because now I see a part-time employee would be about 9%. That's not enough because you're full-time. You're the owner. The other expenses here, general expenses in your studio, 432. 932 is 42. And you got 42% total. We've got 40% cost of sales, therefore a 60% gross profit. And we go to 82% total. Then you got 17.89%. You say, well, Andre, I'm doing okay here because I got 27,000 left. I can pay myself there. How much of a lifestyle will you have with $27,000 in your pocket? You can't raise a family on that. There's no way. And PPFA does survey every 2 or 3 years. They do a benchmark survey on salaries. Do you know what the average 30,000? This would be studio profit plus employee owner's compensation. That's salary and profit for the studio. 30,000. I'm sorry, but I can't raise my kids on this. There's no way I can raise a kid. Therefore, there is a problem with us not understanding those numbers and those ratios. So we have to consider that. And PPFA teaches the same way. We just vary slightly on the percentage on the 0.5. If you go times 4, you're 70%. I prefer to go to times 5 because for the reason I said earlier. Now let's look at a studio that has the same sales but kept their cost of sales at 20%. How do you keep your cost of sales at 20%? By multiplying your cost of producing a product times 5. Period. I would put exception to framing. I'll tell you why the framing is most of the time framing, you don't do it themselves. You just call the manufacturer, send me the frame. You do not carry inventory, or hardly, and you do not manipulate or transform the frame. I would mark up the frame twice or 3 times, depending on the frame. Sometimes you can get a really nice frame that has a lot of perceived value, and you can bump it up 4 times. You can do that. I've seen photographers do that. The beautiful frames, you get good supplier, nice quality frames, but then the perceived value is way above, and they can go more than 2 or 3. Normally the frame manufacturer will say, multiply your frames by 2, right? Is that what they say?
No.
Then you can play on that. But frames, I would not necessarily go 5 times because it would put it up to a much higher level. Same as wedding albums. If a wedding album, you go to these fancy like Queensberry wedding albums from New Zealand, that will cost you $2,000 to put together. So, but these are extremely high-end wedding albums. If you bump it up 5 times, well, you have to find a good clientele for that. So let's look at this one. We've planned for a salary here. So we're up to 35% in salaries. We have 20% in cost of sales, though we have an 80%. So we have some money left. We got the same amount of money, 32%, or 49,000 in your fixed expenses. But I just added the salaries here, which would be the owner's salary. The owner's salary. 54,000. Then you get a 67%, you got an 80%, so therefore you got 12% left. Do you understand the relationship here that we have to go through in order to see if because we have to plan for our salary so that we can get a definite final fixed expense ratio. Is this, people are nodding, but if you're doing this way and you're not showing it physically, ask a question. And I really want to get into it because it's important for you to understand. It's basic math, it's basic profit and loss analysis, but it's so crucial because that's going to determine if you're going to move up enough making money to pay yourself a salary. You need to cover yourself a salary.